right. Yes. So we start last week, we were looking at credit risk and how financial institutions are able to manage their credit risk. And we looked at this several ways of managing credit risk. Those were the online the videos that I would have posted. So when we talk about credit risk, without rehashing what is credit risk, why are banks exposed, why are financial institutions, sorry, exposed to credit risk? And why is it important? One, how are they exposed to credit risk? And two, why is it important for them to try to manage that risk? Anybody? Just put your hand up and open your mic. Volunteers?
Is it, I'll go. So is it a case where borrowers will potentially default on their loans so that banks will not be able to receive that cash flow that they
Right.
issued, and if they aren't able to get compensated for what they've issued, then the institution can go into bankruptcy?
Yes, the institution can go into bankruptcy, become insolvent because they're defaulting on their loans, and persons are defaulting on loans because remember that not only that, but you have banks, financial institutions can also experience losses because those loan payments act as a form of liquidity for the banks as well. And if the bank expects a certain amount of liquidity through its loan payments, then it ends up being exposed to liquidity risk also, right? So many of the risks are interrelated, and yes, that is essentially what credit risk is and why they need to ensure that they manage that. In addition to loans that they issue, financial institutions also purchase bonds. Banks in particular purchase bonds, treasury bills, one as part of their investment portfolio, and two, they also use treasury bills and notes as collateral for the short-term loans that they get from other financial institutions and from the central bank. All right, so that's part of the critical importance. Now, we would have learned about their individual, how banks would manage their individual loans, how they would assess their risk. So they would be measuring their risk, and there's different models that they use to measure their risk. So some of you would have gone over that yesterday, right? So those are the individual loans for individual persons and companies, all right? But banks are not only just interested in the individual loans, they have to also pay attention to their overall loan portfolios, because if their overall loan portfolios are not properly diversified, then they are further exposed to credit risk, right? And exposed to different types of risk that can lead them to exposure to market risk as well. And so financial institutions also have to look at the risk to the overall loan portfolio. So they pay attention to that overall loan portfolio. And in looking at the credit risk from the loan portfolio, what they do is they use a number of models. They use several models for determining their loan concentration risk, right? Because as a financial institution, if you are lending to, for example, in our part of the world, you're lending most of your loans are to hotels, and there's a natural disaster, there's a hurricane, there's COVID-19, the hotels are going to be hit and they may not be able to pay their loan. So if they're heavily concentrated in particular sectors, then that is called, they're exposed to loan concentration risk. And so they use a variety of tools or models to help them to determine what their risk is, how much risk they're exposed to. So what are those models? What are some of those models? Anybody can tell me from going through the notes and reading? And we'd have also touched on some of it yesterday for the folks in 3076. What are some of those that they use? The models that they would use? Anybody can think of what they are?
The qualitative model.
Nicholas, I missed that. What you said?
The qualitative model.
Those for the individual loans. We're talking about the loan concentration risk. So that would be the loan portfolio. What are the methods they use? So one of those methods, I'm gonna share my screen. I'll just and just write it so that you see. So they use something called migration analysis. Okay, and what migration analysis is, they look at the credit ratings of the borrowers in their loan portfolios. So if there are companies, there are institutions they're going to look at the credit rating, they're going to monitor the credit ratings. So company ratings would be AAA, triple B, triple C, D, right? I'm using Moody's there. Some you have S&P that uses A like that, and B that sort of symbol. So with the migration analysis, they're gonna look at the number of loans that they have in AAA with AAA rating. So the percentage of AAA, all right, the percentage of triple B loans, the percentage of triple C loans, and the percentage of D, all right? D is much lower, so they want to make sure that the higher percentage is concentrated in A, B, and C. But what they do is they look at the percentages here. So they may have 15% here, they may have 12% there, they may have 5% here, they may have 2% here, right? And over time, they check to see, so as time goes on, they check to see which firms go from A to B, right? Which firms may go from B to C, which firms will go from C to D. And so they check the percentages, how the loans migrate by their ratings over time, right? And they will determine how much they want to be exposed. So they create what you call a loan migration matrix, right? So in that matrix, they will show you they will see. So you have a risk rating for your loans at the beginning of the year, right? And so they have their ratings. They would have their ratings at the beginning of the year. Okay. And then they're going to insert there. They're going to look at the over time, the risk rating at the end of the year. So they're going to look at how much of these loans are in these categories, right? So they're going to prepare a matrix. So you may have a matrix that looks like, 1 second for me. So they're going to do a matrix. And they're going to put on an amount here. So that's 85% of their loans are in there. Maybe a 12% is in there. All right. And a 3%. And they're going to see, so you have 85% A, all right, 12% B, 3% C at the beginning of the year. And as the year moves on, how they see how it changes over time, right? To see what their concentration looks like of loans in the particular categories. That's very important for financial institutions because they don't want to have too many loans concentrated in the triple C bucket because they expose themselves to a higher loan concentration risk. So although they have in that first, at the beginning of the year, they may have 85% of their loans in the triple A bucket, they're going to try to move that over time, over the year, and then over 2 years and 3 years, they're going to see how the loans are moving. So, for example, for loans that started in the year at a triple B rating, all right, they're going to see if any of them are downgraded or if any of them are upgraded. So about 12% may have been upgraded to A, right? Whereas 83% have remained at a B, and then 3% downgrade to C. So they monitor that. And what they do is they restrict the supply. They restrict the amount of loans that they give in the particular, with firms in that particular rating. So if they see too many firms going, the B firms migrating down to C, then they are going to change the weighting of who they issue to. If they notice that a larger percentage of the B firms are moving up to triple A rating, then they would make decisions based on that. So their loan portfolio comprises of companies with the different ratings, triple A, triple B, triple C. All right. Over time, they're going to see which of these triple C's have defaulted. All right. So those companies that are downgraded from B to C, a percentage of those may have defaulted on their loans. And so what they're going to do is they're going to restrict the amount of lower quality loans that they issue. All right, so they will concentrate more of their portfolio on the AAA graded loans. The thing with migration analysis is that by the time they get the information from the rating agencies, it may be too late. Companies may have started defaulting already, right? And so they could have a problem there. but they would also have other measures in place because they're going to have alerts to see when a company has not paid or when a borrower has not paid. So they use multiple methods to monitor that loan portfolio, right? The other method they use is something called concentration limits, all right? That's very simple. And what they do is the financial institution set limits on particular types of loans. So what they do, they set a firm maximum amount of loans that will be made available to a particular sector. So they determine the concentration limit on the proportion of the loan portfolio that will go to any single customer. And in identifying that limit, they will tell you that they are not willing to permit losses exceeding a certain percent of institutions, so a certain percent of their institution's capital to a particular sector. So if they think that the amount they will lose in default per dollar is, let's say, 20 cents, then they are going to limit the percent of their portfolio exposed to a particular sector, and they are going to look at the default, how much they lose per dollar, right? So for example, let me give you an example of how that works. All right, are you still seeing my screen? Tash, you still seeing the whiteboard? Okay, good. So they use the concept of concentration limit. All right. And they actually have a calculation for that. So your concentration limit is the maximum loss as a percentage of capital. All right, so that's the concentration limit. And so if a company decides that the maximum percent of its capital that it's willing to lose based on a loss rate of let's say 25 cents to the dollar, all right, it can work out its concentration limit for that sector. So the concentration, let's ignore that. Yeah, so your concentration limit formula for that is the maximum loss as a percentage of capital. So is maximum loss as a percentage of capital times 1 over your loss rate. Okay, so if the bank, if an FI says that it will allow it will permit losses exceeding, not exceeding, I'm speaking faster than I write, 15% of capital. At a loss rate of 25 cents on the dollar. So this is an example. What is a concentration? What is a concentration limit? All right, so what you would do there is your concentration limit is going to be equal to your the maximum loss rate, which is 15%, times 1 over 0.25, because it's 25 cents on the dollar. All right. And if you calculate that, you're going to get 0.6 or 60%. The concentration limit to this particular sector is going to be 60%. All right, so it's going to select the sector and determine the concentration limit to the sector. All right, so based on the rating, the average rating of the particular sector, of a particular sector, then it's going to the financial institution is going to set its limit. So if, for example, so if it changes the limit to 10%, because it recognizes that the majority of companies look like they're being downgraded, and it pulls back the rate to 10%, all right, then at the same 25% on the dollar, then the concentration limit would be your 10% times 1 over 0.25. All right. And that should give you, I believe it's 0.4 or 40%. Let me just double check that. So that's 1 divided by 0.25 times 0.1. Yes, you're going to get 0.4 or 40%. That's your concentration limit. All right. Any questions on that? Any questions, class?
No, ma'am.
That's pretty straightforward. Okay.
Yes.
All right. Okay, good. I'm going to take a pause. Let me stop sharing. I'm going to take a pause. I need to take attendance because I would have thought that everybody would have been here, since you don't have to go to make it down to campus. But I don't know if some persons have decided to take the time as an afternoon off or something. So let's see who's here. Alicia Christian is here. I see Ashant.
Yes.
All right. Carolina. Denisha is
Here.
here. Darwin. Joanne. Tora is here. Kyra. Layla. That's from 2005. Lavar is here. Marsha. Hello, Marsha. You're quiet. Yeah. Okay. Did I see Heaven earlier? Heaven, are you on? Yeah, no? Okay. I answered the question earlier. Zaraya. Sharaya. Okay, Nikisha did send a Nikisha did indicate that she'll be absent. All right. I see Simon there. Okay, so I have a good few people missing because one group, okay. All right, well, I hope some others will. Yes, hi Tiffany.
I'm not sure if you got me because I'm in school and I keep dropping out.
I have you. Who I don't have that I'm seeing now is the Vincia. All right, Zoraya, you have a question? Or you're just saying you're here?
Yes, Miss, I have a question.
Go ahead. Go ahead.
You would have uploaded a link for last week, isn't it?
Last week, Friday?
I think it, yes, last week.
No,
I
I
think it was on
didn't.
Friday or Wednesday.
No, what I did for Wednesday was to post. It wasn't a link. It was actual videos of on credit risk.
Oh, because I tried clicking it, but then it told me that I would have needed a password.
Okay, so I had asked a student to share the password with everyone. I actually did put the password after. Go back on Moodle, the password should be there.
Okay, thank you.
I posted the passwords after when I realized that it needed the password because the links I had posted for the previous videos I recorded didn't require the password. I would just click on the option to not require the password, but for some reason, those links didn't post that way. So I had to share the password. So I did put it on Moodle. Check it out again and I will check it after this class. And if it's not there, then I'll fix it. I will post them. All right.
Okay, thank you.
You're welcome. All right, so we would have looked at concentration limits. All right, we spoke about migration analysis. Those are some of the, are you hearing me? Chassie, hearing me?
Yes, Miss.
Did you see the example I did on concentration limits? I think my screen share, you saw it?
That we did with the
Just now.
40% little while.
Yeah.
Yes, I saw that, but I'm not seeing anything at the moment.
Okay, all right. Okay, I'm just making sure that you were seeing it before. I took it down, but did anybody need to write it down or you're good? Because I can put it back up for a few minutes. Does anybody need me to put it back up?
Yes, please.
Okay. So tell me, you can let me know when you're ready to move on.
You can go ahead.
Okay. All right. So with loan portfolios, financial institutions can also diversify their loan portfolios using portfolio theory. What portfolio theory says is that the more in portfolio theory, it's securities, right? So the more securities you have in the portfolio, the less your risk, because portfolio theory tells you with a greater number of assets in your portfolio, you diversify the risk. And so the same concept can be applied to loan portfolios, right? You can actually, using portfolio theory, you can calculate the return on the loan and you can also calculate the risk, the potential risk on your loan, right? So I'm going to just show you an example of that. I'll show you an example of the loan portfolio diversification using portfolio theory. I'm gonna just use the example from the book, which just makes it easier. Because I'm not gonna really go through the example, we'll just look at it from the text. I'll share the screen again. All right, so what they do with loan portfolio theory, the financial institution would calculate the return on the loan. So remember, we would have calculated the return on the loan. Yeah, remember that? How we calculated the return on loans? Yes, I'm going to say you should have remembered that, but I know for 2005, we didn't have the students in FINA 2005, we didn't have tutorial last week, and so you didn't get a chance to actually do the calculations on the return on the loan, right? But yes, we did return on loans in 2005. To me, we did. 2005, we did do the return on loans, right? The examples, I remember. Correct me if I'm wrong. No? Yes? No? Are you all hearing me?
No, ma'am,
You're
we just
talking
did
about,
the return loan. We just
Huh?
did
we did
replacing
RSA.
gaps.
Right. Okay, good. So what I'm saying here with the loan portfolio diversification, using modern portfolio theory, the financial institution would know what the return on each loan is. And so using portfolio theory, they can also calculate the return on the overall portfolio, right? Using the formula for return on a portfolio. And based on the risk posed to the risk of each loan to the financial institution, the credit risk, they can calculate the return on their entire loan portfolio, right? So the expected return, the way you calculate it is it's the sum of the return on each asset times the proportion of the asset in the portfolio. So, for example, I'm gonna do an example. Just bear with me a moment. All right, so let me stop sharing this one, and I'm gonna share the whiteboard so that you can see the example. All right, so the return on the loan portfolio, all right, using portfolio theory is equal to the sum of this here is the proportion and this is the return on each loan. Okay, so let's say assume that there are 2 loans, all right? So the proportion based on the value of the loan, one is 60%. So loan A is 60%, loan B is valued at 40% of the portfolio. The return on A is 15%, and the return on loan B is 20%. All right. The return on the portfolio is going to be your 60 times 15. Okay, so 60%, so 0.06 times 15 plus the 40% times the 20% return. Okay, so if we do that calculation, you can do the calculation. This one is I did not, this is not a pre-planned example. Okay, so this works out to 0.09 and 0.4 times 0.2 is 0.08. So the return on the loan portfolio is going to be 17%. All right. So the financial institution knows what the return on the portfolio is going to be because it knows the proportion, it knows what percentage, what return is it gets from those 2, but that's just 2 loans. You know, financial institution are going to give 2 loans. Financial institution will probably give hundreds of loans, right? But that is, you can use portfolio theory to determine the return on the loan using the weighting. So X1 is equal to the weight and RI is equal to the return, the weight or the proportion of the portfolio. Okay, in dollars. Now, just like you can use the portfolio theory to get the return on your loan portfolio, you can also use portfolio theory to determine the risk of your loan portfolio. All right. And the formula for that is a little bit more involved because what you're really looking for is the variance of your loan portfolio to do that calculation, right? So we will look at a short example on that one. All right, a very short example. It's just a 2. Again, we're gonna look at the 2 loan portfolio. All right. So with a 2 loan portfolio, if you're looking for the return on the loan, not the return, but the risk in the portfolio, you're going to need to know what is the risk, all right, of that loan to the financial institution. You're also going to need to know what is the covariance between the two loans. Covariance meaning what are the chances that both loans will default, or what are the chances that both loans will be paid. All right, so that's the risk. Using the portfolio theory to calculate the risk of the loan portfolio to the institution, will be able to tell the financial institution, yes, I'm getting a 17% return on this loan portfolio, but at what risk? All right, what is my risk of default with this 17% return? So they already have an idea, because for the individual loans, they'd have calculated the risk of default on the loan. Should remember that one from last week. So they would calculate the risk of default on each loan using one of the models, whether the qualitative or the quantitative models. They can use portfolio theory now, utilizing the risk information from those models, plus the return information, and work out the risk on their overall loan portfolio. Right, so the formula for that is a little bit more, slightly more complicated. Those who did 2004 with me would have an idea. So
Dr. Isam,
yes.
do we have to remember these formulas?
No, for this, I would give you the formula for this one. The
Oh,
simple
okay.
formulas, yes, but for this, something like this, I would give you the formulas.
Okay, no problem.
So I'm just writing the formula here, and then I'm going to explain the formula, okay? I'll tell you what the formula means. All right, so you still seeing the screen?
Yes, we are.
Okay, all right, so in this formula, let me change my pen color. In this formula, so what we're looking for here, risk is calculated using the statistical term variance. All right, so if you have a series of data, you could find the variance between the results of an experiment, for example. All right, and you know that when you're calculating variance, I'm assuming everybody did quantitative methods by now. Maybe not everybody, but the majority of you, those in 3076, should have done quantitative methods. And so you should have an idea, of variance. So the variance of a loan portfolio can be calculated pretty much the same way as the variance of a security portfolio. And so the different parts of the variance of a loan portfolio would be the sum of the weights of the loans in the portfolio squared times the variance of the loans in the portfolio squared, all right, plus the sum of the weight and the covariance. This here is called the covariance, which would be given to you, all right, in a situation like this. You would be told what the covariance is. So for a two security portfolio, if the financial institution wanted to find out what the variance was of that loan portfolio, then it can find out the variance. All right, for the portfolio. The variance meaning the risk. Okay, so you would have, I'm going to show you the example from the book, and then we can come back and do an example. So let me switch to the text to show you the example from the text. All right, so in this one, somebody had a question? Okay, so what you're seeing here is that, okay, for my mouse, okay. So what you have here, the book gives you, can you see it, or I need to make it bigger? It's good?
Yes, Miss.
Okay, so in this question, it says, suppose that a financial institution has two loans with the following characteristics. For loan one, the weighting of the loan portfolio is 40%. Loan one is 40% of the portfolio. The return is 10%. The risk of loan one, or the variance, in this case, the standard deviation, is 0.0857, right? The covariance is 0.00734 squared. That's the standard deviation. This is the variance. The correlation coefficient is a negative 0.84, but the covariance between the two loans is a negative 0.0070548. The proportion of loan two in the portfolio is 60%. The return on loan two is 12%. Loan two has a standard deviation here of 0.0980, and loan two has a variance of 0.009. So your standard deviation is simply the square root of your variance. Now, so the risk of the portfolio, remember, if you go back to the formula, right, is your weighting squared times the return squared, times your weighting squared times your variance squared, right, plus your weighting squared times your variance squared. So this is loan one, this is loan two. All right, plus 2 times 0.4, which is the weighting for loan one, times 0.6, which is the weighting for loan two, times the correlation coefficient, all right, of the two, right here, times the variance of one times the variance of the other. That is what the formula actually showed you. All right. So what you're doing here is plugging into the numbers to the formula that I showed you before. I'm going to ask that you go over this example, and I'll give you one to do for homework. I'll ask that you go over this example in the text, and then so for homework, I'll give you a couple of those to do, just for practice. All right. The point here is that a financial institution is able to calculate the credit risk on on its loan portfolio, the overall credit risk, because you want to know what is, yes, you know the return on the whole portfolio, but you also want to know what the risk that you face, even though, so you may be getting a good return. The portfolio that the return that we calculated earlier was 17%, but what was at what risk, you know? So the bank wants to make sure that it limits its risk to its overall portfolio. And portfolio theory tells you that the more loans you have in your portfolio, the less your risk to the financial institution. Any questions? We will go over those in tutorial. So I'll give you some questions to work on, and we will we'll go over them in tutorial. All right, so I think, let's see. So I'll give you so number 7 on page 346 of my text. I'm not sure what is the, not sure what is the page in the other text. All right. So I want you to do number 4 and number 7 at the end of chapter 11. Chapter 11 is credit risk, loan portfolio, and concentration risk. So you'd look for the chapter, loan, credit risk, loan portfolio, and concentration risk. So those number 4, number 7. But like I usually do, I'll just post them in the portal so that you there's no confusion about the pages. All right. Okay, so I think it's a good time to take a little break. I know online can get a little a little difficult. So we'll take a 5, and then when we come back, we're gonna discuss liquidity risk. Okay? Everybody with me?
Yes, miss.
Okay. So I'm gonna pause the recording. All right, so we're gonna talk about liquidity risk. As you recognize that as we get deeper into the discussion on the different types of risk, we have some more involved calculations. We started out very basic, straightforward, but now we are doing a little bit more of the quantitative type measures, because we're measuring risk, and it's important that financial institutions use a lot of quantitative models to address or to manage their risk, because they have to collect data and they have to input this data into models to help them with dealing with to manage the risk that they face. So with the interest rate risk, we saw that they have to look at things like net interest income. So they need to know the total assets exposed, the interest rate risk, total liabilities, and so on. We just went through credit risk, and you saw that the financial institutions need to have models to manage that. In addition to those models, the regulators also provide them with guidelines as to how they can mitigate some of those risks that they have. And so what we're going to do later on, not today, a little later down in the semester, we're going to look at what is in place to assist financial institutions with managing these risks in terms of prudential guidelines and so on. All right, so liquidity risk. What's liquidity risk? We would have touched it at the beginning when we spoke about the different types of risk. What's liquidity risk? Anybody?
So would it be, I think you mentioned, potentially when persons, default on their loans, banks could have an issue where they're unable to meet their daily, I'm gonna say obligations for lack of better words.
Okay, their daily liquidity needs. All right, that's one way, one example. Zoraya, you had your hand up.
I was going to say something similar.
Anybody else? Okay, thanks, Zoraya. Anybody else? Go ahead, carry on.
It's basically when businesses or an individual aren't able to meet their short-term financial obligations,
Yes.
often due to instability,
Instability in cash
to
receipts.
convert assets and so forth.
Right. So they are not able, yes. So they have a shortage in liquid funds. And so they may not, they have that shortage in liquid funds when they have to convert liquid assets. When they have to convert assets, they may not be able to convert them at rates or prices that are advantageous to them. They have to do something like a fire sale where they end up converting them at less than competitive rates, right? So with financial institutions, we look at really you focus on banks, right? Because those are the ones, banks tend to give loans more so. Banks and other financial institutions like your credit unions, your finance companies, and so on, right? So these companies, once they give loans, they face liquidity risk. Liquidity risk is really where for commercial banks in particular, where there is a sudden call on the liquid funds of the institution, right? And so basically what you have is their deposit, you have deposit withdrawals due to a crisis of confidence in the institution. However, financial institutions can also face abnormal demands of cash due to different reasons. And we know that financial institutions, they operate on a daily basis and they have cash needs. They have cash needs because persons would do what? What do people go to the bank for cash for?
Make purchases, buy assets.
To make purchases, yes, okay. Simple, basic. We get paid at the end of the week or at the end of the month, and we're going to go and take out some cash from our account. All right, because we need to pay our bills, we need to buy food and so on. Now, financial institutions, due to the activities that they do, they will need funds. And so they may need funds above and beyond what they take in as deposits on a daily basis. All right. So you have off-balance sheet loan commitments, which financial institutions may have to borrow additional funds at high cost for those, because they may issue a loan commitment on behalf of a company, and then the company is not able to meet that obligation. They may have to sell off assets in a short period of time, like I said earlier. So when a financial institution faces cash demands that are not normal, then they have to purchase funds, get loans at higher cost than normal. And so they would have to liquidate assets at low prices, or what you call fire sale prices. If you have a situation where there is a run on the financial institution, then it could threaten the stability and the profitability, the stability of the institution. The institution could go insolvent. All right. A liquidity problem is not always a solvency problem. A liquidity problem becomes a solvency problem when the financial institution is not able to, it does not have access or can't get access to funds, right? So financial institutions have to ensure that they monitor their daily liquidity needs. And their daily liquidity needs involve their loans, when they're issuing loans to customers, the normal cash demands of customers. If they issue commercial paper and they have to pay out, they have fixed deposits that come due, and customers may want not just the interest, but they may want the principal also. That is why financial institutions will send out a notice to tell you your fixed deposit is coming due. What would you like us to do? And they send that out early, so they have an idea if they're going to need the full amount or they just need the interest to pay you. Now, financial institutions have exposure to liquidity risk based on the nature of their operations. So depository institutions like commercial banks, credit unions, they have high exposure to liquidity risk, all right? And any loss of confidence in lending between banks is going to affect liquidity across the board. Insurance companies, life insurance companies, have moderate exposure because persons are not coming in, won't go in and cancel their policies, just like that. There would be some notice. Policies have a life, and usually the insurance company will send you a notice, all right? So they don't have the same sort of liquidity needs as a financial institution, and they are not paying out. They know exactly what they need to pay out, except when they're, for life insurance in particular, they know exactly what they have to pay out based on mortality rates and that sort of thing. The low exposure financial institutions are places like mutual funds, hedge funds, pension funds, and property and casualty insurance companies, all right? Those have low exposure. Remember, low doesn't mean zero. They do have some exposure still. Now, where does liquidity risk come from? How does a financial institution end up facing that risk? Comes from two sides. You have on the liability side of your balance sheet, and you have on the asset side of your balance sheet. So for commercial banks, what's the liability side, Weaver? You know what a commercial bank balance sheet looks like. We went through that. What's on the liability side of the commercial bank?
Deposits.
Deposits. And so if you have a number of customers coming in at once to and demand all the money in their account, you face a risk there. All right. So you have depositors. What about the asset side?
Loans.
Loans, yes. Okay. So if the institutions run into a problem, then they have to get liquidity. There are different ways they would get their liquidity. What are those? Just think about it. Think about it from elements of banking and finance, and in our brief discussion about liquidity risk earlier on in the semester. Where would a commercial bank, other financial institution, how would they access additional liquidity?
Would they borrow from other financial institutions?
Yes, they would borrow from other financial institutions. And they can also borrow from where?
Central bank.
The central bank, yes. Yes. All right. Okay, good. So in borrowing from financial institutions, that is interbank. If it's commercial banks, that's interbank. All right. The other types of financial institutions can borrow from their commercial banks. All right. And so that's how they would meet those liquidity needs. And we're gonna do some examples. Now, remember we said the second cause of liquidity risk is asset side liquidity risk. So you off balance sheet loan commitments, the other liquidity requirements that they have, and they would meet those by their cash amounts and additional borrowing. Now, we know that your depository institution or your commercial bank, your credit unions, all right, their balance sheet would be showing their demand deposits. So you have your savings account, you have checking accounts, and then you have your longer term. So that's on the liability side. On the asset side, you have your loans, right? So we know that if you have a deposit at the bank, you can go to the bank at any time and ask for your funds, all right? And so that the depository institution needs to be able to pay that out to you. How it is they do that? Now, commercial banks are not going to keep, if everybody has $500,000 in the bank, they're not going to keep the amount of cash that would cover everybody's deposit. All right. We know that banks issue loans. So when you make your deposits, the bank is going to use your money to issue some loans. All right. And so it won't have all the money on hand. When you withdraw, there are people who are depositing on a daily basis. And so the bank has some liquid funds. The bank would also have cash in vault. All right. The bank would have cash in its vault that it can use as well. And then Sometimes they have excess cash at the central bank above their reserve requirement. All right. So they can use those funds to offset any liquidity needs that they may have. The managers of these institutions, they therefore have to monitor their daily withdrawals. They need to know the trends, all right, the withdrawal trends. And so we know at certain times of year, you need to have more cash on hand than normal. Certain days of the week, you may need to have more cash on hand as normal. I'm sure many of you may have experienced the Friday afternoon drama where the ATM runs out of money, right, before the night. And so financial institutions need to have that cash. Now, financial institutions experience drains, what we refer to as a deposit drain. And they have the deposit drain because of persons coming to demand their funds and just normal day-to-day activities. All right. Sometimes they are sudden, they are unexpected. And so you would find that the banks have to borrow. They have to get the cash from somewhere. So to manage the deposit drains, financial institutions do so. They can use purchase liquidity management, all right, which it's an adjustment that occurs on the liability side of the balance sheet. So we are withdrawing our deposits and they would purchase liquidity, so they would get a loan, all right, whether from another financial institution or from the central bank. Then there's stored liquidity management, where the bank would cover that deposit drain by taking funds from the asset side of the balance sheet. All right, asset side, that being your cash. So they take deposits from there. Financial institutions tend to rely on stored liquidity management as their main mechanism for managing liquidity. However, as time has gone on, institutions tend to access money through the money markets from other institutions and from the central bank. And so they tend to rely more on purchase liquidity management for liquidity risk and other cash shortfalls. The purchase liquidity management, what it does, it allows the financial institution to maintain its balance sheet without changing the amount of assets it has or the composition of its assets, right? So you have a deposit drain, and when you purchase liquidity, you take on a loan on your liability side of the balance sheet, all right? And you keep the asset side of your balance sheet intact. So you maintain your cash, your existing cash, your existing short-term assets, and you take on a loan. So you have had increases in purchase liquidity management over time, right? It can cause a problem. The regulators have concerns about it. And so they are cautioning against the purchase liquidity management, because you could have a cash crunch. It calls it a liquidity crunch, but you could have a cash crunch where several institutions are purchasing liquidity, and you end up with a problem. All right. So we know that purchase liquidity management means you're taking funds from your central bank. We say federal funds here because the book is American, but it would be from central banks. You could enter into what you call repurchase agreements with the central bank or with another financial institution. Usually, you're going to be borrowing funds at higher rates than what you pay on your deposits. And so you have interest rate risk coming in there. All right. So banks have to balance the interest rate risk with the liquidity risk. And so that's why management is so important. Now, the other side is the stored liquidity management. All right. So you have purchase liquidity management, stored liquidity management. And what you do there is to liquidate your assets. So you use your cash. You may liquidate some securities rather than to purchase liquidity or enter into a loan with another financial institution. When you run down your stored reserves, then what happens? You have your reserve requirements that you have to meet, and you have your excess reserves. All right. If you are holding this excess cash, then it means you are losing money in the sense that you're not going to get interest or significant interest on cash holdings. Central banks don't normally pay interest on cash. All right. So instead, financial institution will do a combination of purchase liquidity management and stored liquidity management. So what we're going to do is to just have a look at how financial institutions would address the deposit drain issue. You should have done it in elements of banking and finance. If you haven't done any banking and finance, then we have to learn it here as well. So we also know that in managing deposit drain, sometimes a bank could end up going insolvent if the bank doesn't have enough capital to cover the deposit drain. If it's a crisis, if it's a real cash crunch and a crisis, the institution could run into problems. All right. The financial institution also loses liquidity when it has to sell off its investments or its assets at fire sale price, is going to lose value there. And so any losses made there, it can recoup those losses through purchase liquidity management or stored liquidity management. So financial institution, it has an investment portfolio and which it uses. And because nowadays investment portfolios are marked to market, so when the value changes in the stock market on a daily basis, the value of the portfolio changes. Sometimes financial institutions need to replace that value. That is done by purchase liquidity management or stored liquidity management as well. So it is a number of things. All right. Any questions so far? Okay, if not, very quickly, I just want to run through the tools that the financial institutions use for measuring their liquidity position. So you have something called the net liquidity statement. All right. It's going to look at its assets and its liabilities, liquid assets versus liquid liabilities, and it measures that on a daily basis. And so it has that net liquidity statement. There are ratios that they use, peer group ratios. Many of these are set by the central banks or the regulators. And you have the liquidity index. There's financing gap analysis. Remember, we did that in a similar thing in interest rate risk. Then there's the liquidity coverage ratio, net stable funding ratio. So the liquidity coverage ratio, net stable funding ratio, those are accounting ratios. So they monitor their balance sheets on a daily basis and a monthly basis as well. The regulators, particularly the central banks, pay attention to the liquidity coverage ratio, the liquidity index, the net stable funding ratio. So those are measures that, or indicators that financial institutions have to calculate on a daily basis, and they have to report them to the regulator fairly regularly. All right. So just in a little bit more detail, the net liquidity statement, you have your sources of liquidity. So you have your cash assets, the borrowed funds available, plus your excess cash reserve. So that's on the cash side. So that's your sources of liquidity. And then the uses of liquidity, borrowed or money market funds already utilized, any amount already borrowed from the central bank. So it's almost like a cash flow statement, but it just captures the cash type assets, the borrowed funds available, so the short-term funds. All right, so it's like a short-term cash flow statement. So it's source of liquidity, uses of liquidity. And so that is used by the financial institution to see the status on its liquidity. Then you have the ratios, so loans to deposit ratios, borrowed funds to total assets, commitments to lend to assets. Those are financial ratios again. And what they do is the institutions compare their ratios to similar institutions within the same area. So let's say, for example, for Antigua and Barbuda, the central bank is going to look at those ratios for the financial institutions within the currency region. So you'd have to understand what the different ratios mean. So a high ratio of loans to deposits and borrowed funds to total assets suggests that the institution relies heavily on short-term money market rather on core deposits to fund loans. So the ratio of loans to deposits and borrowed funds to total assets, it means that the institution is relying more on the short-term money market than on their core deposits to fund the loans that they give. All right. If that ratio is high, it could indicate a future liquidity problem, especially if the institution is at or near its borrowing limit in the purchase funds market. All right, then you have, so you use those ratios for peer group comparison. And the liquidity index, it's the weighted sum of the fire sale price to the fair market price. And you use the portfolio weights, which is a percentage of the portfolio value, which is made up of the individual assets. So the index is the sum of the weights times the fire sale price over the fair market price. So that's how you'd work out the liquidity index. And then there's the financing gap. So So they look at their financing gap, which is a difference between what? Well, what do you think the financing gap is? That's a question based on everything we just said. What do you think financing gap is?
The difference between loans and deposits.
Sorry, 1 second, okay, let me are you still hearing me?
Yes.
Oh, okay. All right. I thought I lost you for a minute. Okay, so I'm sorry. Okay, so you're right. It's the difference between your loans and your deposits. All right. So your average loans minus your average deposits is your financing gap. And so your financing gap plus your liquid assets will give you a financing requirement. And you can switch the numbers around. The financial institutions will switch the numbers around to find out what their obligations are. Okay, so again, financing gap can also be used in peer group comparisons just to see where the institution is. All right. As I was saying earlier, the central banks uses some ratios. So the Bank for International Settlement, Basel Committee on Bank Supervision, there are two regulatory standards that they use for liquidity risk measurement, which is the liquidity coverage ratio and the net stable funds ratio. And those were commercial banks were asked to implement these in 2019 and 2018 respectively. All right, so how you calculate liquidity coverage ratio is your stock of high quality assets over your total net cash outflows over the next 30 days. And so what they would like to see happen is that the financial institution has sufficient, a relatively high level of high quality assets that can be converted in cash to meet liquidity needs within a 30-day period. All right. Yeah, so that is one of the ratios they use. And then there's the net stable funding ratio, which is the available amount of stable funds divided by the required amount of stable funds. That needs to be greater than 100. All right, and so what that does is it encourages the stable use of the use of stable sources of finances. And so they need a minimum amount of stable funds over a 1 year period of time. Right? So financial institution needs to have stable funds over a 1 year period. And that will help to reduce the liquidity and the foreign exchange risk. Part of the reason this is necessary is that financial institutions have becoming more and more engaged in off-balance sheet activities. And so the regulators are trying to encourage them to ensure that they have that stable source of financing to help them deal with any crisis that could occur from the off-balance sheet activities. Any questions? No questions? All right, if there are no questions, I'll post the questions I want you to do for homework And then we're going to discuss more about a little later on in the semester. When we have covered all of the different risks, we're gonna talk about some other ways of dealing with each of the risks. And then we're gonna also look at the Bank for International Settlement, what their requirements are. We look at the prudential guidelines, and so that will help. How do banks deal with deposit drains in a more in a coordinated and efficient manner? What are some of the things that they do to manage liquidity risks and credit risks in particular? All right. So if you don't have any questions, that's all I wanted to cover for
Dr.
today.
Yates, I have a question.
Go ahead.
Tutorial for FINA 205 is online or face to face
It's
on
going to be
Friday?
online. It's going to be online. Everything for this week is
Okay.
online for me, for my courses. So it will be online. Okay. Next week we are back to normal.
Dr. Gittens, I missed that. What did you say was online?
Tutorial for 2005 is online on Friday. But next week everything returns to normal.
Oh, okay, no problem.
So tutorial for 3076 will be face to face next Tuesday. Zoya, you have a question?
Not sure if you would have mentioned this already, but what's the for the midterm?
Format for the midterm. It's going to be short answer and calculations. And it covers credit risk. It covers up to credit risk, including concentration limits, the concentration limit calculation.
Okay,
We
thank
won't,
you.
not the portfolio theory calculation, not the risk and the return using portfolio theory. Okay. So remember, next week, Wednesday, is your midterm. All right. So do your studying, and the homework is practice. So, well, the concentration limit part of the problem. Be sure to do your reading, go back over the readings, look at the examples in the textbook, okay? You use the slides as a guide to see what areas you drill down more on in the text, okay? Any other question? Okay, if not, I'll see some of you on Friday. Rest of you, I will, well, Friday online, and rest of you face to face. Everybody face to face on Wednesday, Tuesday and Wednesday. All right? Okay, bye everyone.
Bye.
Bye.